How big of a degenerate gambler is Warren Buffett? The answer, obviously, is not very much. However, what about Warren's business partner, Charlie Munger? You might expect, given the similarities of the two men and their long history of working together, that they would have a very similar investing style. But that isn't necessarily the case. Both men grew up in respectable middle-class families, and both were determined to make their fortune. However, their paths to making their first millions, before they became partners, were quite different. Whilst Warren always eschewed debt and made what he considered safe, low-risk investments, Charlie displayed a somewhat different attitude to risk, debt, and investing tendencies that aren't entirely unfamiliar to today's degenerate meme stock and crypto investors. In fact, some of Charlie's earlier trades may make you question how he ever ended up with Warren at all. One such trade was a takeover arbitrage in 1962. By this time, Charlie was already rich. He had made money by investing in California real estate and from managing a small investment partnership. However, by early 1962, Charlie had liquidated all of his real estate holdings and the investment partnership, and he was cash rich. Never one to be idle, Charlie found the perfect repository for his wealth, the British Columbia Power Company. This wasn't an exciting company. It wasn't growing particularly quickly, and it wasn't especially profitable. In fact, it was generally unremarkable, except for one thing. The Canadian government had announced their intention to nationalize the company at a price of $22 per share, against a market price of $19, a near 16% return. Charlie decided to YOLO into this deal, and he did so on a huge scale. He initially invested 100% of all that he had. His savings, the cash from his liquidated real estate portfolio, and all of the cash from his investment fund. However, this still wasn't enough for Charlie, and so, in the style of a meme stock investor, Charlie borrowed an additional $3 million from the Union Bank of California, so that he could get an even bigger slice of the pie. The risk in this deal was huge, and not the sort of thing that Warren Buffett would have done. If the deal fell apart, and the share price fell below the $19 purchase price, Charlie could have been wiped out, especially after accounting for the $3 million loan, and he would have to start again from zero in building his wealth. The thing is, Charlie didn't see this as a risky deal. He reasoned that the risk profile was very low. After all, the acquirer was the Canadian government, and so financing wouldn't be an issue. Plus, there couldn't be any regulatory concerns, because the government is the regulator and wouldn't be inclined to block their own deal. Finally, the British Columbia Power Company couldn't really fight the deal. When government decides to nationalize a company, there really isn't anything that can be done about it. In Charlie's mind, this deal was about as sure as the sun rising tomorrow morning, and that is why he felt so comfortable to risk everything he owned and more to get a slice of the pie. And not surprisingly, it turned out he was right. Charlie's Degen trade proceeded just as he thought it would. The Canadian government bought British Columbia Power, and the investors got a 16% return, which translated to more than $1 million in profit for Charlie. As Charlie would later say,
"You should remember that good ideas are rare. When the odds are greatly in your favor, bet heavily."
Still, I can't see Warren ever making such a hugely concentrated trade on a single transaction. But according to the men themselves, Charlie had a greater effect on Warren's investing style than everyone other than Ben Graham. What about you? Would you ever go 100% into a single trade and then borrow even more to juice your returns? Anyway, I hope you found this video interesting and that you'll join me for more of the same next time. Thank you for watching.